Hey everyone, welcome back to Earnings Call. My name is Jeffrey Beamer. I'm the Senior Investment Strategist over at ewotrader.com. And if you've been with us for a while, you know we don't just talk about stocks. We talk about how to profit from company earnings announcements. We do it each and every week. Earnings happen every week, believe it or not. So this week, the week of June 1st, 2026, features a lighter earnings calendar, but several higher profile reports are expected to drive sector rotation this week, and as well as single stock volatility. And you're not going to believe some of the stuff that's going on, so you're going to want to stay tuned. Broadcom actually headlines the week, but there are several key reports coming out in the AI, semiconductor, data center, infrastructure space. And while AI and data center names remain top of headlines, no doubt about it, let's not forget that this week there is another major theme, and that is retail. We have Dollar General, Ulta Beauty, Victoria's Secret, Five Below, Ollie's Bargain Outlet, Lululemon, several others. They're all going to be offering their insight into consumer spending, pricing power, inventory trends, and how the market looks really for the end of the year. Okay, here we are in June already. So we're going to go through the list. We're going to take a look at last week's trade, some good potential candidates for this week, and you're going to want to stay tuned because there's an interesting dynamic occurring this week that is very unique to this week, at least so far to this week. So, and I will have a new trade opportunity for you. So let's get it going. All right, each and every week here, we talk about earnings, and we break it out into two categories. Okay. On the left-hand side of what you're looking at here are what we call the breakout stocks. These are high volatility movers. They average double-digit moves every earnings announcement pretty consistently. Okay. Every now and then there might be a single-digit move, but most of these move double digits every earnings cycle. On the right-hand side, we have what are called our quiet stocks. These are stocks that average 9% or less. So breakout stocks, 10% or more, so double digits or more. Those are the moves that are expected. And then on the right-hand side, we have the quiet stocks, single-digit movers. Now, usually we get movers that are 3, 4, 5%. This week is going to be a little unique. So let's start talking about the quiet stocks first, because they may not be so quiet. All right. So let me start with an example of Pfizer. Now, Pfizer does not have earnings this week, but this is an example of a notorious quiet stock. Okay. Pfizer has an average move of 4% through earnings, and it just does not move. So not only is it a non-mover through earnings, but it's really a non-mover through the rest of the cycle, okay, between earnings periods. It just doesn't move very much at all. Now, for these candidates, we like to trade a strategy called an iron condor. This is a simple medium level option strategy that is two vertical spreads combined together. You have a bull put spread on the bottom, a bear call spread on the top. It's done at a credit. And what we want to happen is the stock remain between our break evens by expiration, and we get to keep the entire credit. So let's take a look at our list this week, because that may be a little challenging. Now, you see here our list, but let's go to the quiet stocks. Okay. We have, let's start with Hewlett Packard. SAIC had earnings this morning. All right, so let's start with Hewlett Packard, and then we'll work our way. You can see that there's a handful of names here. Dollar General, I want to call your attention to Dollar General, Palo Alto Networks, Ulta, Broadcom, CrowdStrike specifically. Okay, maybe even Ciena. That these stocks, even though they're on our quiet list, are in sectors that have been demonstrating some extreme movements. Okay. And the risk here for these is a little higher than normal. So let's get to the chart, and we'll start with Hewlett Packard, because again, here's a stock that has a average expected move of just 5% through earnings. Now, this is not a number that we come up with. Okay, this is a combination of how the stock has reacted over the past, I use the past year and a half of earnings, so 6 earnings cycles, combined with what's the estimated move that's being priced into the front month options provided by the SIBO, okay, Chicago Board of Options Exchange. All right, I am looking at the estimated move that the option market makers are pricing in to these stocks. Okay. And for Hewlett Packard, as an example, it's 5%. However, Friday, okay, you can see the gap up in stock price. That's a 12% gap on news that wasn't even earnings. Okay. Earnings come today, June 1st, after market close. And even though the average move here is 5%, in this situation where there's a little bit of news, I like to go try to get my break evens about 10% out of the money, 10% above, 10% below. But that's going to be hard on a $45 stock to do that. All right. I always check, but oftentimes in my experience, it's somewhat difficult. However, Hewlett Packard is in a space that this could possibly move close to double digits. So just be careful. And that is the theme of the week on these quiet stocks. Okay. Let's get through the list and I'll talk about that a little bit more. Okay. Starting tomorrow, Tuesday, June 2nd, before market open, we have Dollar General. Now, Dollar General has an average move of 7%. But the way that it is, let me just throw a stock on here that is not on our list that had earnings last week, and that was its sister company, Dollar Tree. And look at that. Look at that move. Look at that gap higher. Had an average move of 8%, and Dollar Tree moved on earnings, gapped up 17%. It doubled. Literally doubled its average expected move. Okay. So with that knowledge, since Dollar General is in really the same space that Dollar Tree and Walmart are in, and I'll talk to you about Walmart in just a moment because that was our last trade that we did. Okay. So we're going to do a trade review of it. Okay. I would be very careful with Dollar General here because it could be a mover. Now at $100, I would like to get my break evens, double digits away from the price. But again, if the stock moves 17% like Dollar Tree did, that is, having your break evens 10% apart it's not gonna matter. Okay. So I would sit on the sideline for Dollar General and I would just watch it. Okay. Because it has a history of moving, and you can see even though it gapped down last earnings cycle, that was a couple of percent move, but this one was troublesome here 2 days in a row. Gap up, rally higher all day, and then a follow through the next day. So it does tend to show a little volatility around earnings, and even though its average expected move is 7%, I would kind of stay away from it. Okay. Moving on, we have Palo Alto Networks. Okay. This stock is up 4% today after, a big move yesterday. This stock is in the news quite a bit. That move yesterday was almost 10%. It was 9.3%, this move yesterday. So this thing is really moving. It has an average expected move of about 7%. All right. And they will declare earnings tomorrow, Tuesday, June 2nd, after market close, by the way. But again, another one here's how I would play this, honestly. These stocks that are in the news quite a bit, I would look also for them to break out, like I was mentioning with Dollar General. And it's all about option pricing. And if I can get a Straddle or Strangle really cheap on this, which I checked this morning, and on a $300 stock, it's not cheap. Okay. It's breaking that balance between should I do a Straddle or Strangle and expect a big move, or should I do an iron condor and expect a quiet move? The answer to that is this might, again, be a sideline stock. Okay. This might be a sideline stock. Now, so it all depends on the pricing and where market makers are pricing the options, but I would be very careful with it. I don't know if I could get my break evens far enough away to do a trade on this, but we've had pretty good success with it. You can see last earnings announcement, a little gap down, not much, and then a little gap back here in late November. But again, it did not negatively affect our trade. We did trades on these both the past two earnings cycle, and they worked out. Okay, that for a positive return. But this one has a little different feel to it. Okay, now going over to the retail space, we have Ulta Beauty. They will have earnings tomorrow, June 2nd, after market close, and this one. Okay, the average expected move here is about 8%. However, over the past couple of earnings cycles, as you can see on the chart, because I have them identified with the vertical dotted line here, this stock is starting to become a mover and is about to hop into my breakout stocks, which we'll talk about those breakout stocks in just a moment. Okay. But again, this is going to be on the higher end consumer or medium, kind of medium to high end consumer. And again, I would be very careful with this one. Now, normally I don't say this about the quiet stocks, and I'm actually very aggressive in trading them. Okay, anytime they show up on my quiet list, I'm all over it usually. But the stocks that are on the quiet list this week are just setting themselves apart. Why? Well, let's continue on our list. Here's Broadcom. Okay, Broadcom has an average move of 6% through earnings. Okay, but after its previous earnings announcement, where it moved a decent amount after earnings, but had big follow through to the downside. Okay, you can see over the past two earnings cycles, the stock has gapped around a little bit through earnings. And again, I'm not worried about this rally right here. I'm not worried about the sideways action that it went through here. I'm worried about what it does through earnings and the next couple of days afterwards. Okay. Because I'm looking to capture high implied volatility by selling premium and then waiting for the implied volatility to rush out, called an IB crush, rush out of these options. And that is how we make our money on the trade, combined with time decay. Okay. Those two factors play good. And again, some of these tech stocks that are in the news quite a bit, that have quiet average moves lately have been a lot more volatile in this current environment. This won't last forever, but right now, this might be a stay away stock, as well as CrowdStrike here. Look at this. This stock is up 4% today, but look at this rally. This stock has gone from roughly at the beginning of May, was at 447. 447 at the beginning of May. And here we are on June 1st, and this stock is at 764. Okay. A move from 454 roughly, okay, 450, okay, to 764 in a month. I'm not worried about that move. I'm worried about what it does through earnings. And right now, CrowdStrike is getting a lot of press. I would expect this to go ahead and move. Even though it's on my quiet list, I would expect a double-digit mover out of it this week. And again, look at what happened last time. This is the move I expect. Okay, look, you can't even barely see the bar here because it's so quiet. It's just in the regular. See how quiet? The stock just doesn't move out of the ordinary around earnings. This gap right here, that was not earnings. This was right here. And look at the volatility around here. Okay, rally up and then immediately back down the next day. All these trades, the past 3 trades that we've done on CrowdStrike have been winners. Okay. This next one I'm concerned about, just with this inflated algorithmic trading that is happening within this group could be troublesome. Okay. This is the sort of information you want by tuning into this show, by the way. Okay. Because you're not going to get this anywhere else. All right. CNBC is not talking about estimated moves, except for one guy. His name's Oliver, and he reports from the SIBO. Okay. He's pretty good. Okay. He'll tell you where, what's being priced in. In fact, he said today, CrowdStrike is pricing in a 10% move on the options. He actually singled out CrowdStrike here and said that the market makers are pricing in a 10% move for CrowdStrike. Okay. So combine that with the average historical move, and we're looking at about a 7% number here. That's why it's on our quiet list. But for this week, I'd be very careful with this. And we're looking at a possible double-digit mover. Five Below is a retailer. If you're not familiar with Five Below, I don't have my little box on. Okay, they're going to declare on Wednesday. Let's just double check. I don't know where my box went on that, but I can tell you that is going to be aftermarket close. So Wednesday, July 3rd, aftermarket close. And the average expected move here, hold please, is around 7%. Okay, around 7%. Now, last time, okay, this is a $200 stock. So if that candle looks big, realize that this is a $200 stock. That was not a 10% move. Okay, you can see the previous move here, the previous non-movement here. Okay, a little gap up and then move down. That is the movement we expect from Five Below. However, some of these retailers are really starting to move quite a bit. Okay, like Abercrombie and Fitch. Let's see, last week, I believe when they had earnings, okay, they didn't do too bad. They gapped up a little bit going back, but you can see what this stock does. This is on my breakout list because look at these moves, big moves through earnings. Okay, big moves through Abercrombie, and the average move here is 18%. Okay, that that was three earnings cycles ago. Needed to adjust. Did I adjust that number? Didn't adjust that number. But anyway, so watch out for Five Below. I would be very cautious, but honestly, I would consider, because it's a $220 stock, I could get my break evens if I could get them beyond 10% away from the money, 10% above, 10% below. So that's 10% of 230. Okay, is $23 above. Okay, $23 below. Minus my credit, that means I could probably do it $20 above and below. So really, if I could get it up here around 245 to 250, sell that, and then down below that, $20 away, around 210 or so. That would be, and then hedge it, okay, by buying further out of the money options. And I don't go more than $5 wide, by the way. Okay, on my spreads, keep that risk low. All right, but I would watch out for Five Below. Ciena, I'm going to sound like a broken record here. Okay, this could be another double-digit mover this week, even though it's on my quiet list. It's one of those that I normally wouldn't show because it's right there in that 9%, 10% window, but market makers were pricing in, believe it or not, this week, they were pricing in a 7% move. But Ciena is in a space that, they are in the networking technology, hardware, software space. And just the way these things are trading is just crazy right now. So be very cautious with any of the quiet stocks that are on our list this week. This is very unique. Okay. That they're just, this group right now is very, very risky. Okay. All right. But with that said, then let's talk about the breakout stocks, because we do two other strategies around earnings. So we do iron condors around the quiet stocks, and we do straddles and strangles around the potential volatile stocks. Now, here's my list for this week. Let me show you an example of a breakout stock, though, real quick. Okay. This is Akamai. Akamai is a double-digit mover. I mean, this thing moves consistently. It's usually priced around 13 to 14% movements through earnings. Now, Akamai does not have earnings this week. This is just an example of what a volatile stock looks like. You can literally see where the earnings events are because there's usually a big gap. While big gaps don't always indicate an earnings event, okay, it's a 7 out of 10 times, 8 out of 10 times, it's an earnings event, okay? So let's get back to our list real quick, all right? We have an interesting list starting with retail, okay? Victoria's Secret tomorrow morning, and then we get into some tech stocks, GitLab, Rubrik, DocuSign, interesting, and IoT, which is Samsara. We'll talk about these. So let's start with Victoria's Secret. Now, I really wanted to do a trade on Victoria's Secret today. It declares earnings tomorrow, Tuesday, June 2nd, before market open. So first thing in the morning. The average expected move here is about 13%. I priced out a trade on Victoria's Secret, and it is pricing between 18 and 20% move. Now, here's the thing. If it's pricing an 18 to 20% move, and the stock tomorrow, we wake up and it's up or down 25%, that would have been a great trade. But the average move, okay, combined with the pricing at the time, is around 13%. So that's usually a skip for me. Okay, that's usually a skip. I'll skip that and I'll just sit back and watch it. Okay, but that's a double-digit mover. And price it out. Again, straddle or strangle. Straddle is buying two options, a call and a put, same strike price, same expiration date. A strangle is a call and a put, but different strike prices, same expiration date. That's the difference between a straddle and a strangle, okay? So, Victoria's Secret tomorrow, GitLab also tomorrow, but that's after market close. Now, look at this. The stock is up 7% today at the time this little snapshot was taken. It was up even bigger yesterday. It has rallied off the lows in mid-May of $22.50 to $27.50, a $5 move on a $20 stock, okay, in 2 weeks, and then it starts gapping higher. That would be indicative of a potential big move. And, I wouldn't pay more than $5 for a straddle or strangle on GitLab, but it's pricing in a bigger move right now. It's pricing in for a 16 to 18% move right now. And again, when its average move is about 12%, and you can see what it did last time, it just didn't move last time. What's different this time? Okay. Now, again, the gaps on a $40 stock are like, they don't look big, but they are big. Okay. Percentage wise. But this thing is really moving. We could get some additional volatility through. So GitLab might not be a bad idea, but all of these tech stocks that we're about to talk about are up over 7% just today. Okay. Like Rubrik. Okay. They will announce on Thursday, June 4th, after market close. The average move here is about 16%. I priced it out this morning, and it's pricing in a 20% move for Rubrik. So, I mean, geez Louise, this thing is cooking. It is up now 8% for today. So it was 7.69 just a few minutes ago. It's up over 8% now. It was up 11% yesterday and up 6%, almost 7%, 6.85% right here, 6.85. Then you get a double-digit move here, and it's not even earnings yet, okay? So Rubrik is really pricing in a move, And again, this company is in the cloud data management solutions kind of category. They've got contracts with Microsoft and the whole deal. But man, these things are moving already ahead of earnings. Okay. Let's talk about DocuSign for a moment. DocuSign will have earnings on Thursday, June 4th, after market close. Now, here's the thing. DocuSign is starting to quiet down. You can see the last earnings announcement was a quiet move. Okay. We had a little gap down back in December prior to that, but this stock used to be a big mover. I mean, look at, it would gap up, and look at this gap back down a year ago. A year ago this time, this stock just cratered. Okay. So that's why the number seems big, even though the last couple of earnings announcements were quiet. But now, look at the move it's making. It's up over 7.5% today. It was up 9% yesterday. I mean, crazy moves in anything in the tech kind of space. I was just seeing if there was any news updates there. Nope. So 6% yesterday, 7% today. I was looking for the news on it, and okay, a little bit of news regarding shareholder vote, but that's about it. All right, and then we'll finish out our candidates this week with a company called Samsara. And it's got an interesting symbol. The symbol's IoT, which has no reference to to the stock name. Although Samsara is in a connected sensor, it's a connected sensor company, manufacturer, wireless connectivity, that sort of thing. And look at it; it's moving 9%. Yesterday, another 9% today. I mean, this thing is cooking. Actually, that was 10% move yesterday, upwards of 9% today, and their earnings aren't until Thursday after market close. So just crazy moves for these stocks. And that's why we like trading them. I mean, that is why we like trading some of these. But right now, a lot of these tech stocks are being priced up, making them more expensive than their average moves, which puts the odds against us. And that's what we got to watch out for. All right. So let's review our list one additional time. You'll notice here that no qualified stocks on Friday, and it looks like there's several holes in the list. That's because there's only about 170 companies declaring earnings this week. Let's see here. The number, 72. 185 for the month of June. 185 companies for the month of June. 72 are declaring this week. We're watching about 15 of them, 15 on this list. Okay. It gets quieter as we get through the month of June, but the names are, you don't want to miss our shows in June, because the numbers of stocks of companies declaring earnings get smaller, but they are no less market impactful. They are potential movers of the market. So you'll definitely want to stay with us and tune in through the month of June. And as always, because there's always earnings announcements. Okay. All right. So let's talk about last week's trade. All right. Last time I was with you, I had a decision to make. I could do Walmart or I could do Target. They're in the same sector. All right. I chose Walmart just because Walmart is a consistent winner for our iron condors. Okay. We sell an iron condor going into the earnings event. You can see the dotted line, the horizontal dotted line on top, the horizontal dotted line on the bottom. Those are my break evens in the trade. All right. And normally we go through the earnings announcement. We sell that high implied volatility. We get a nice credit. Earnings announcement happens. The CEO speaks on the earnings call. implied volatility crashes and time wastes away, and we get to keep the premium that we received because it expires. All legs expire worthless, and we keep the credit. Well, unfortunately for Walmart, the CEO started talking and kind of, in my opinion, in this trader's opinion, kind of talked out of his lane and started talking about the consumer on a national level. Now, as a retailer and as the biggest retailer, you can talk a little bit about maybe your customers, but when you start talking about the whole economy and all that, which he did, okay, you're kind of deviating from your spot. Talk about your stock, talk about your outlook, the impact that your company, your customers are going to make on your stock moving forward is fine. But again, kind of talked out of his lane a little bit, and look what happened to the stock. The stock absolutely cratered on that. Wall Street did not like it. That is a direct result of a CEO giving negative comments about their outlook on their stock. Okay? And then that was on Thursday. And then Friday, the stock, we were looking for maybe a bounce and a little bit of relief. But no, we did not get a bounce. Okay? So what happens here? Well, the good news is the call spread that we put on top, that expires worthless. We leave that alone. But the put spread, well, because now both puts, the put that we sold and the put that we bought, both of those are now in the money. What happens is market makers widen the bid-ask spreads, and it makes it a little difficult to get out of the position without risking more than our max risk. Okay? So we took in 62 cents per spread on this. So our net debit was $1.24. Our net credit was $1.24. Our break-evens were $2 apart. Okay? So $2 on top, $2 on bottom. So our margin then was $2, but we did it 2 times. So that makes it $4 on margin, minus the credit of 62 done twice, which is $1.24. That means our max risk was $2.76. Now, why is that significant? Well, that is keeping our risk low for when this happens. So while we were looking at taking in $1.24 and keeping that credit, which would have added a 1.24% to portfolio, how do I know that? Well, we base all these trades on a hypothetical $10,000 account. Okay. And so I'm looking at, when I do these, about a 1.25% return on portfolio per trade. Okay. Is ideal. I love that. Okay. But also, what if I'm wrong? So I only did this trade 2 times. So my max risk is 2.76%. And what happened? Well, we lost that 2.76%. Why is that significant? Well, I don't like losing money. That's not why I'm a trader. That's not why I'm in this business. I'm in the business to make money, right? But losses are something that happen occasionally, and we have to manage our losses. So how we managed it was in how we sized the trade, and in the end, the loss, you got to be careful with percentages, like on risk on return numbers, because you're going to see like, oh, that was a 98% loss. No, it wasn't. It was a 2.76 loss on portfolio. Okay. I can easily overcome a loss of 2.76 on portfolio. Okay. Easily. I could do it with 1 breakout trade or probably 2 iron condor quiet trades. Okay. Easily overcome. Not too worried about it. But I can only be not worried about it because I sized it smaller. I didn't mortgage the house. I did not take on excessive risk. I just did the contract trade 2 times. That's it. Okay. All right. So what do I have for you this week? Well, I just couldn't resist going back to some of those tech stocks and, man, the crazy moves that we're seeing. I did find one with a decent pricing in it, and that is Samsara. Okay. IoT, the one with the crazy symbol in relation to its name. IoT. Now, this trade is about $5. When I priced it out, it was $5.24 this morning, and that would be 5% on portfolio. Okay. The reason why we take a little bit bigger risk with these sometimes is because they'll move, and with a strangle, either your call will hopefully go in the money or your put will go in the money, and while you might not make a profit, your loss will be lessened. Rarely do these stocks just not move. Okay. So here's the thing. The way Samsara is moving, they don't have earnings until Thursday, right? Thursday after market close. If this thing moves and you have a double-digit return, I'm talking 10% or more, like you get into the trade today, and on Thursday, this stock has moved 19% through, Tuesday, Wednesday, Thursday, and you're looking at a 15% return on your trade before earnings, I would close that out and get out of it. Profit. Okay. But if it doesn't, if it all of a sudden stops moving and it just builds up that momentum, like by not moving, just that energy is building up, the anticipation, and it pops up or pops down, we are looking at making a profit on this trade. So a long strangle. And again, if you had a $10,000 account, you would trade literally one contract on this. One contract, a call, one contract on a put. So buy one call, buy one put. Now, if you had a $20,000 portfolio, you could do it 2 times and then 3 times if you have a $30,000 portfolio, et cetera, just like that. Okay. So trade small. We trade often. We trade every week here on Earnings Call. That is our show for this week. We'll look forward to seeing what Samsara does. We'll be back with you next Monday right here for another round of earnings. Some big names coming up next week, so you'll want to be sure and tune in and join us then as well. So everyone have a great trading week, and I will talk to you again next week. Take care.